Hi guys. So last time I talked to you, we discussed fiscal policy. We're going to continue talking about that today. Uh, there was a real emphasis the other day on the concept of collecting taxes. That's the biggest way uh, the government gets money, raises money is through taxes. And we talked about the tax that gets the government the most money is the income tax and how it's progressive tax and all that. Well, today, guys, we are going to look at some other taxes that the government puts on us, including the corporation income tax. So, corporations they have to pay uh, a tax on their net income for the year. So that means, net meaning the amount of money they made after all their costs of running a business. So you might hear people talk about being tax deductible and all that. So depending on what it is, they might say, well, I'm taking this off. It was an expense for my business. So I only really made this much. And so that means less money being taxed by the federal government. You also have social insurance tax, guys. So this is where the federal government they use payroll taxes, and so basically you have like Social Security, Medicare, unemployment. All that is withheld from your check, and so that is basically what they do with that. And so you have employers that they are paying on these things as well. Um, so it's kind of a mutually put into kind of tax. Okay, and so with this, guys, we refer to this as a regressive tax. So we talked the other day about flat tax, or hopefully you looked at flat tax. Some people refer to it as a regressive tax because obviously that means the more money you make, the less you're being impacted by the tax. The less money you make, the more you're being impacted by the tax, since it is a flat tax. And so basically, that's why they refer to it as a regressive tax. You also have an excise tax, guys. That's a tax on items that are not necessary. So food, clothing, medicine, those are all exempt from an excise tax because they are necessary, very necessary, obviously. And so, for example, guys, uh, tobacco and liquor, those are things that can be taxed that are excise taxes that they are not essential or necessary for people to have. It's just they might want to have it. And so, a lot of times, guys, an excise tax is twofold. One, obviously, you're trying to raise money. The other is you're trying to get people to stop doing that thing, right? So taxes on cigarettes are really high. That's because the federal government doesn't want people to smoke. It's unhealthy for them. Okay, and so they're saying, hey, if you want to do this, you're gonna have to pay for it. You know, uh, we don't want you to do it, but we can't or won't ban it because of liberties and freedoms, things like that. So hey, if you really want it, you're gonna have to really pay for it. So it's to try and get people to do it less sometimes. You also have the estate and gift tax. So the estate tax, guys, is a tax imposed on assets of a person who dies. And so we're talking about estates worth 3.5 million or more. There have been some recent changes to this, and this is kind of interesting. So you have basically Republicans; they refer to the estate tax as the death tax because most Republicans are opposed to it. Um, so obviously, death kind of adds a sinister connotation to it. Um, so this is an interesting one, but basically, yeah, um, if you inherit some kind of estate that's worth this value or more, then you can pay a pretty heavy tax on it. And this is a little controversial. Um, so there are farms and ranches and all that, when you take into account equipment and shops and buildings and the land, that they might equal that, but you're not having that in liquidity. You're not getting that in cash, and so it can be difficult, for those type of people to hand it down from father to son or whatever, because then they have this huge tax they have to pay. And like I said, you can't really operate your business if you're selling off of those things to get liquid cash. Not actual liquid cash. That's what they call it, guys. When you're dealing with cash, is liquidity. Um, so you also have, like I said, the gift tax, guys. So this is on anything $12,000 or more. So when your grandma sends you a check in the mail for $20, she's not paying a tax. She's not being taxed for that. It's quite a pretty good size sum of money where they'll actually tax you for that. And then customs and duties, guys. This is another form of taxation. And so basically, any goods that are brought into the United States, they could be susceptible to a duty tax, customs duty. Uh, it just depends on that port of entry and all that. So, for example, at Galveston, Texas, so they do a lot of cruises out there. My wife and I went on a cruise for our honeymoon. Uh, my my mom loves coffee, and so we were in Jamaica, and they had this kind of coffee, cream, rum stuff that we bought her. And when we brought it back to the U.S., when we got off the ship, they said, okay, we see you've claimed this, this, and this. Okay, you have to pay a tax on this rum. So we have a duty tax for alcohol. Okay, and so that is an example of a customs duty, a tax on goods that you're bringing into the United States. Okay. All right. Well, that does it for this section of our notes over fiscal policy. I hope you guys have a great day, and I'll talk to you later.